Welcome back. Let's talk about dividends, which are a return of premium that has already been taxed, commissioned, and paid by the policyholder. When an insurer has a profitable year, they may choose to share their success with policyholders in the form of dividends. There are two types of whole life policies: participating and non-participating. Participating means the policy owner will receive dividends declared by the board of directors, while non-participating means they will not receive dividends. Let's say Pearl's $450,000 participating whole life policy is eligible for a $60 dividend as declared by the insurer's board of directors. As the policy owner, Pearl can choose how she'd like to receive this dividend. Instructor lists the dividend options. Pearl's options are: Number 1, receive the dividend in cash. Number 2, apply the dividend toward future premiums. Number 3, accumulate the dividend at interest. Number 4, use the dividend to purchase paid-up additions. Number 5, use the dividend to accelerate a pay-up option. And number 6, use the dividend to purchase a one-year term policy. If Pearl chooses the cash option, she'll receive a check for $60. If she applies the dividend to future premiums, she can skip or reduce her next premium payment. If she lets the dividend accumulate at interest, the insurer will hold on to it and add future dividends and interest until the balance reaches a more significant amount. Pearl could also use the $60 dividend to purchase a $500 paid-up whole life policy as an addition to her base coverage. Paid-up additions are purchased at net premium rates, which are lower than the gross premiums Pearl would pay for a new policy because the dividend has already been taxed and commissioned. Over time, these paid-up additions can add a significant amount of coverage to Pearl's policy, and they're fully paid up, so they'll remain in force even if Pearl cancels her base policy. If Pearl has a limited pay policy, like a 20-pay life insurance plan, she can use her dividends to accelerate the pay-up date. Instead of paying premiums for the full 20 years, Pearl might be able to use her dividends to pay off the policy in 19 years and 8 months. Finally, Pearl could use her $60 dividend to purchase a one-year term policy for a short-term insurance need. For example, if Pearl takes out a $10,000 loan and wants to make sure it's paid off if she dies before repaying it, she could buy a one-year $10,000 term policy, making the lender the beneficiary. To recap the dividend options, we have our cash, apply toward future premium, accumulated interest, paid-up additions, accelerate a limited pay, or one-year term. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 29. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 29. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 29. Good luck and keep up the great work.